Hey, it's Justin Harvey. Thanks for tuning into the Anesthesia and Pain Management Success podcast. With APM Success, we take a close look at important topics pertaining to business, practice management, personal finance, and careers for anesthesiologists and pain management physicians. We work hard to take your critical questions straight to the experts. Thanks for listening. Hello and welcome to APM Success. Coming to you today with a solo episode, going to be talking about some investment strategies for a down market and give some additional economic context for what's going on right now. So the recording date of this episode is the end of April 2025, and the tariffs instituted by President Trump and the somewhat opaque policies surrounding their implementation have created a lot of market craziness in the last few weeks. There have been a few interesting observations that I've made. One of the conversations that I've had both with clients and other friends has been, does it even make sense to invest international anymore? Or should we just keep on, buying the good old S&P 500? What we have seen this year, and this has been even more exacerbated in the last few weeks, is that international developed markets, as of today, on a year-to-date basis, are up about 9%. The S&P is down about 12%. So we're seeing about 20+% single year-to-date outperformance on the international markets. So it's a core part of our investment approach that maintaining international exposure, both international developed and emerging markets economies, is an important part of a well-diversified portfolio. And finally, right now, that diversifying component has been making money compared to the home team, S&P. But in light of the market uncertainty, I wanted to talk about investment ideas for a down market. Buy and hold is a thing that is out there that is one way to describe the way an investor would buy the market when they have a long time horizon. And while that is in some ways a beneficial approach, there are absolutely things you can be doing when the market is rocky in order to be thinking strategically for yourself and trying to enhance your net worth over a long period of time. None of what follows, obviously, is specific advice for you, but these are things you could consider or talk to your advisor, or if you're looking for someone to help you implement some of these ideas, we're taking on new clients at APM Wealth. And the net effect of these strategies, when implemented in a disciplined way over time, is that it does help your portfolio compared to not. So I have seen I have a couple clients, and I've had a couple conversations with prospects as well who have had a bunch of cash on the sidelines. Specifically, a handful of hundreds of thousands in a checking account, and they've been waiting for the perfect moment to get into the market, quote unquote. There's a lot that I could say here. The first thing is you got to have a plan. So just buying in and trying to catch the bottom is always a mistake, because actions apart from a plan are not going to land you anywhere that's worth being. So understanding the time horizon associated with the dollars is the first step. But if you do decide that a long time horizon is the appropriate way to think about the cash that you have on the sidelines, meaning I'm not going to need this money for another 10, 20, 30 years. It's destined for financial independence, and I don't need it to buy a house, buy a car in the next couple of years, or some other shorter term expense, then it makes sense to deploy this cash. A couple ways you might do that. One is to do a lump sum investment in a diversified portfolio, meaning I take the whole $500,000 and I drop it all into my model portfolio, a mix of stocks and bonds, a mix of US and international, a mix of large cap and small cap, growth and value, a fully diversified portfolio. I'm just going to drop it all in today. If you do that in a down year, then here's one thing to bear in mind about market timing. It's impossible to do, first of all, for the average retail investor. But as markets go down, the expected return on a forward-looking basis goes up because of what we call mean reversion, meaning markets will over time, or they tend to over time, return to their long-term average return in subsequent years. So if markets are down, then this suggests about the next 1, 3, 5 years, the forward-looking returns are higher as a result. And the way that we quantify this is if we look historically, at significant market sell-offs and when those have happened, and when there are the big down days of 3, 5, 7% down, the biggest up days in the market are tightly clustered, statistically speaking, around those big down days. And therefore, if you are adding money to the market in a time when the market is, over the last week or month, has been doing very badly, statistically speaking, if we look at what has happened in the past, it suggests that you have a better chance of big up days in the near future. Now, past performance doesn't tell us anything about the future. It tells us a little bit about some context for investing, and it does obviously explain history to us. It's possible this might not hold in the future, but it is helpful to understand that when things are very bad, that very good historically often immediately follows, unless American capitalism permanently breaks, in which case you should be investing in guns and gold or Bitcoin or something else and not the global economy. I obviously don't think that's a good idea, but that's something to think about. So you could do the lump sum investment. Another way you could consider getting into the market is what we call dollar cost averaging, meaning if I've got $500,000, instead of dropping the whole $500,000 in today, I'm going to drop in $125,000 every month for the next 4 months. Every 30 days, I deploy $125,000. That's another way to do it. This is a way that is accommodative to people who are a little bit uneasy about market volatility, and they like the idea of, I'm just dipping my toe in, then I'm dipping my ankle, etc. And that's fine. And if this is an approach that seems good to you, then that is better than continuing to be in cash, if this is in fact a long-term bucket of money. However, I would point out that statistics, if we look historically, can inform this approach and would indicate that because markets are up most of the time, it's actually better in terms of the probabilistic outcome. It's better to just put all the money into the market and invest the whole $500,000 right now today, rather than staging it in. You're likely to have a greater terminal net worth or terminal portfolio value with this $500,000 if you invest the whole thing today, rather than if you take the next 4 months to do it. So something to be aware of if you're considering, if you've got a bunch of cash, you're thinking about what to do with it, you've decided it's long-term cash, and you're wondering, should I drop it all in or should I stage it in? Statistics says drop it all in. Second thing to be aware of, this is an opportunity for, is portfolio rebalancing. Now, in some cases, this is a little controversial, and I'm not going to get too far into the weeds of the mechanics and research around rebalancing, but it is a mechanism whereby you can reduce portfolio volatility and buy low and sell high in a systematized way. Whenever you're rebalancing, what you're doing is you're selling assets that are above your target weight for your portfolio, and you're buying assets that are below the target weight. So if we take the example of the last month, where stocks are way down, bonds are relatively stable, and actually international is up and US is down, what we may do if we rebalance is we're going to sell some bonds, some fixed income, if it's a stable, high-quality fixed income that hasn't moved much. We're also going to sell some international stock that has gone up, and we're going to rebalance it into US equities, which have gone down. This is a process that requires proactive activity from the investor, and it's a time where, especially when the stock market sell-off happens in US equities, increasing your exposure to that asset class will allow you to benefit more when the stock market recovery happens. Another thing, a third item you can be doing right now is tax loss harvesting in a time of market sell-off. What this means is you're selling a security that has gone down. You're locking in the loss for tax purposes. Part of the Internal Revenue Code, the way that it's set up, says that you don't pay taxes on gains until you sell it and realize the gain. Similarly, you don't benefit from a tax loss until you sell the security and you realize the loss. So to give a practical example, what I might do is if I was piled into NVIDIA this year and I'm very sad because my NVIDIA portfolio is down 30%, maybe I sell my NVIDIA stock, and I want to keep consistent market exposure to a similar company, so I might sell Nvidia and buy Google. And at the same time, I'm maintaining that constant exposure to the equity market, but I'm also locking in that loss for tax purposes, so that if there's $10,000 of losses that I'm realizing, that $10,000 is going to help me this year to offset capital gains. 3,000 of that 10,000 can offset ordinary income, which is a nice benefit, especially for high income earners who are paying a high marginal rate on their earned income, their ordinary income. That $3,000 is going to offset your wages, your W-2 income, your salary, which is really nice. The remaining 7,000 is either going to offset capital gains in the current year, or it can be carried forward in what's called a capital loss carry forward. I liken it to a piggy bank that you take with you into future tax years, so that whenever that capital gain does happen, then this capital loss carry forward will offset those gains. This one in particular is really helpful for entity owners. If you have a surgery center, if you own a practice, if you own a bunch of rental real estate, often liquidating some of those assets, whether it's through a succession plan or you're reconfiguring your balance sheet, you're selling a thing, you're realizing a gain on your rental property or on your practice or your surgery center stake. If you have been diligently capturing capital losses along the way by tax loss harvesting, then this can be a really important way to offset that future tax bill. And right now, when the market is way down, is a time, I liken it to being in that, have you ever seen that, you're in one of those inflatable booths with a fan in it and there's the money flying around and you get 30 seconds to grab as many dollar bills as you can and stuff them in your pockets before the timer's up. A precipitous stock market sell-off is one of those times. It's here for a short amount of time. There's money to be made in terms of this strategy, and then that opportunity will be gone. So you need to capture it while it is here. This strategy is sort of put on steroids whenever you're using a separately managed account, what we might call direct indexing, where instead of holding a few ETFs, you're holding a bunch of individual securities. You maybe have 500 or 600 or 700 different, for example, US large cap companies that are over 10 billion in market cap, that are domiciled in the US, that fit a certain number of criteria. If you're exposed to that many different companies, it's almost guaranteed that some of them, if the market's down 10%, some of those companies, and if we look at our FANG friends, Facebook, Apple, Amazon, Netflix, Google, and we can add Nvidia and some of the others, Tesla, they are way down this year. And so being able to, in an algorithmically driven way, realize tax losses when these significant price movements are happening, automatically flip the proceeds into a similar security, that's a really valuable and important tool. So being aware that that is out there, that is something to consider for a taxable account in particular. So that also bears mentioning. Tax loss harvesting only works in a taxable account. It doesn't work in your IRA, it doesn't work in your Roth IRA, it doesn't work in your 401k. This is only a brokerage account where you can have taxable activity happening. Another strategy worth considering, number 4. This is particularly for retirees or pre-retirees, although this could potentially apply to anyone. And that is thinking about Roth conversions while assets are down. One of the reasons that this can be helpful is if we go back to what I was saying about the forward-looking returns of a market, of an economy, of an index, the forward-looking returns improve when the market goes down. Meaning if the market goes down 50% in the next 6 months, then I can expect that the market is going to rebound a lot in the next 1, 2, 3, 5 years, and that the returns over the next 5 years may likely be above their historical norms in order to, correct, to return to baseline. If that happens, a specific opportunity around traditional IRA, 401k conversion exists where when asset values are down, you can incur taxes at a lower account value. You're going to convert these assets, meaning if we take a practical example, say I've got $500,000 in a traditional IRA. The stock market gets cut in half, so now it's at $250,000. If I'm a 62-year-old, I'm sort of pre-retiree, I'm living on cash, I'm waiting on Social Security, and I've got this opportunity where my earned income is not as much. This might be a chance where you take that 250K, you convert it, meaning you move it from a traditional IRA to a Roth IRA. You're paying ordinary income taxes on that 250 grand. The net amount goes into the tax-free Roth IRA. And then whenever you experience the market rebound, you're paying that lesser tax cost because you're paying it on 250 instead of 500. You're getting it into that tax-free account, and then you get the big market tailwind, the springing upward of the index, and you get all that tax-free, so that whenever you do get that money in retirement, or whenever you give it to your kids after you pass, then it's all in a Roth instead of a traditional. And this is a really interesting way to reduce the tax burden on the life cycle of that group of dollars. Now, this is one of these things where it's difficult to specifically model the benefit, but we can philosophically observe the benefit, where converting whenever assets are depressed in value, paying less taxes then, flipping over into Roth, and then having the tailwind of the market recovery in the tax-free account, that can be a meaningful lever to reducing your tax bill, yes, but also to even taking advantage of the opportunity to sort of reconstitute your balance sheet, especially if you're one of those docs who maybe you never did the backdoor Roth IRA. And instead of doing that $6,000, $7,000, $8,000 a year into the Roth for you and your spouse, you stashed your 401k, maybe you had a cash balance plan. You've got a lot of traditional assets. Maybe you've got $4, $5, $6 million in traditional IRAs, 401ks, etc. This could be a really important strategy for you to create some tax diversification, to get money from that pre-tax bucket into the Roth bucket. And as you're thinking intergenerationally, if you are a 62-year-old physician who has a 32-year-old kid, you want to think about, how much of the money that you have are you going to spend, and how much of it are you going to leave to your kids? And if you do want to leave a bequest, doing that in the most tax advantageous way is a consideration. It's not minimizing taxes is not in itself an end. You want to use the money for what you want it for. But if you can pay less in taxes, all things being equal, we want to do that. And leaving money to your kids in a Roth, especially if they're going to inherit it in their peak earning years of 35, 40, 45, 50 years old. Think about how much money you were making as a 47-year-old. If you inherited a traditional IRA and you had to pay that out over 10 years, that would be probably like the worst possible time to inherit that kind of money, because you're going to incur the top marginal bracket, perhaps, on those dollars for a number of years. And so most of that bequest ends up going to Uncle Sam, or not most, but a meaningful amount. So Roth conversions for pre-retirees right now, this can be a strategic time. The final item I would say is considering, what is the plan that I have for the assets that I have? And this is a good opportunity. Whenever there is market uncertainty, you want to reassess what is the time horizon associated with my invested dollars. And I always have this conversation with clients whenever things are uncertain and anxiety inducing, and then they come to me and say, Justin, we're concerned about the sell-off. We see our portfolio is going down. What should we be doing? And the 4 or 5 items I just listed are things that we are doing. But another important thing is we're going to remember, what is the plan? What is the point? What is the time horizon of this money? And invariably, there's a meaningful part of the portfolio that is not subject to what's happening in the stock market. Probably high quality fixed income, short duration, meaning US government, high quality corporate holdings that have a decent coupon payment and that are not going to be moving too much, either with interest rates moving or the stock market. And as a result, this is a lot of stability in their portfolio. We can look at that and say, that part of it is very, very stable. We're also looking at other sources of income. Maybe we've got Social Security on the horizon. Maybe there's other corporate pensions. We're looking at the big picture. So what I'm going to say to my client in that moment is, has anything in your circumstances changed? Has there been a significant cash need that has happened? Is there a real estate deal you want to do now that wasn't on the horizon 6 months ago? If yes, then perhaps there is something we should be doing with the portfolio related to that new need. But if nothing fundamentally has changed. What we should do is tax loss harvest, deploy cash on the sidelines if needed, rebalance if appropriate, maybe think about Roth conversions, and then stick to the plan. And a lot of the hardest parts of investing have to do with not acting when not acting is difficult. And right now is one of those times. There's an advisor study put out by Vanguard that suggests that working with an investment advisor can add up to 3% in return per annum over the lifetime of an investor. The lion's share of that 3% per year is realized in times of market volatility, because a lot of the benefit of an advisor, a good advisor who understands their client and who is savvy to how to build a portfolio and how markets work, a lot of it is not doing the thing that you want to do when it seems like the sky is falling. And right now, the markets are down 10%. It's not like sky is falling territory, but we might get there. And Warren Buffett famously said, the key to successful investing is being greedy when others are fearful, and fearful when others are greedy. And this is a good moment to reflect and say, am I, where do I fall? My emotional response, and am I reacting emotionally apart from the, awareness of what my plan is? So hopefully this is helpful. Hopefully this is a few ideas for you to put into practice in your own portfolio. I'm really excited for the next conversation I have. Attorney Mark Weiss is going to talk about some of the leadership dynamics that he has observed in anesthesia and pain practices and what characterizes solid group leadership. So you're going to want to check that out. Thanks as always for tuning in, and I will talk to you next time. If you liked what you heard this week, head on over to apmsuccess.com, where you can find more content and free resources to help you build a successful career in anesthesia and pain management. If you wanted to leave a review in iTunes, I'd also really appreciate it. Thanks for using some of your valuable time to join me today on APM Success.